If you don't have any high interest debt, and you do have an emergency fund of around 3 to 6 months of living expenses, you're in a good place financially. There's a good chance you're ready to start investing. But it can be hard to know exactly when the right time to start investing is. Let's start with a good general guideline. When you have some money to save for the long term, possibly for things like retirement or maybe children's education, if you don't need that money for at least the next 5 to 10 years, then investing it in the stock market is a reasonable choice. But when exactly should you invest? Should you do it right now? Or maybe wait for the stock market to go down a bit? Or maybe invest a bit every month and do it gradually? If we look at the evidence, the answer to that question is you should invest as soon as possible. Why? Investing as soon as you can will let you start benefiting from something called compound interest, which is one of the most powerful things about investing. Compound interest is the interest you earn on your initial investment, except every year you earn interest on your original money plus any interest from the previous year, which creates a kind of snowball effect over time. Let's say, as an example, you invest £1,000 at an interest rate of 7% per year for 10 years. In the first year, you'd earn £70 in interest, so you'd have a total of £1,070. But in the second year, you can earn interest on that £1,070, and 7% of that is £74.90. So you can see how that grows over time. After 10 years, your £1,000 investment would have grown to £1,967. You've almost doubled your money thanks to the power of compound interest. Extend that to 30 years, and that's when things get really interesting. After 30 years, your £1,000 would now be over £7,600, and the vast majority of that is just the interest, so you got it for free. So that's the thing with compound interest. It's all about time. The longer you can leave your investment, the longer it has to grow and the more interest you can earn. And the more interest you can earn, the more your money will grow. In reality, the stock market can return 7 to 8% per year, but that's on average, so it doesn't mean you'll see this return consistently every single year. One year it might return 20% and the next minus 8%. So you have to stay invested over time if you want to see this kind of average. It can be really tempting to panic and sell your investments if you see them start to go down, but you'll miss out on future compound interest if you do that. What happens if you sell on that negative 8% year and then don't get back in for the next year, but that next year happens to have a 30% gain? By selling, you're stopping the snowball effect and your investment won't have the chance to grow as much as it could have if you'd just left it alone. The trick is to be patient so you can let your investment grow over time. The longer you can hold it, the more you'll benefit from compound interest. You might also be wondering at this point, well, shouldn't I at least wait until the stock market is down and buy in at the bottom? In theory, this sounds great. But the problem is that nobody, not even the best investors in the world, can tell you when the bottom actually is until it's already passed. What happens for most people who try to do this, by jumping in and out, trying to predict when to buy low and sell high, is that they almost always end up with less than if they just put the money in and left it alone. Why? The main reason is that stock market dips and recoveries are often very volatile. This means that some of the biggest recovery gains often happen on just a few individual days, soon after the market has reached the bottom. And if you happen to be waiting with your money in cash on these critical days because you're worried another crash is maybe about to happen, or we haven't reached the bottom yet, then you'll miss out on those gains. To give you an example of why this is so bad, let's imagine you'd invested £10,000 in the stock market back in January of 2002. By the end of 2022, you would have over £60,200. That's an average annual rate of return of 9.4%. But you'd only see that if you'd stayed fully invested the whole time. If you missed the best 10 days, you'd only have £27,604. And that's an average annual return of 5.21%. But it gets worse. Miss the best 20 days, and you'd have only £16,400. which is an average return of just 2.51% per year. So over this entire 20-year period, there are about 5,000 trading days in total, but missing only 20 of the best days could have cost you nearly £44,000. And that's why trying to time the market is generally considered a bad strategy for normal investors like you and me. There's even a saying about this, which goes, time in the market beats timing the market. If the idea of staying invested through tough times and seeing your investments go up and down makes you uncomfortable, you are absolutely not alone. But luckily there are several things you can do to help with that, which I will cover in this next video. It has the basic steps you need to follow to start investing safely, even as a complete beginner.